And welcome to Sectors Up Close. I'm Angeline Ong. Our focus today is ESG investing, and our guest is Detlef Glow, head of EMEA research Refinitiv Lipper. From global power brokers at WEF Davos to climate change protesters on the streets of London, environmental and social governance, or ESG, is more important than ever. And for investors too. The latest data supplied by Morningstar showed US sustainable funds led by BlackRock ETFs drew $51.1 billion in net new deposits in 2020, more than twice the previous record set in 2019. But indices and ETFs based on ESG investing are surprisingly similar to non-ESG ones. They hold many or most of the same companies, minus naughty stocks such as oil majors, miners, and, as in this case, luxury brands. And their returns can be less than spectacular. The stock's European ESG 50, while it outperformed the stock's 50, remains about 3% lower than it was the same time last year. So what is the point? It is clear investors do want ESG products, but how do they approach this sector? For more on this, I'm now joined by Refinitiv's Detlef Glow. Thank you so much for joining us, Detlef. I mean, we know that fund managers are saying that soon ESG will be mainstream, but for now, why invest in this sector if past performance is any indicator?
ESG is, if you look on it from a broader perspective, like an investment style. And therefore, sometimes it is superior to other investment funds and sometimes it's not. So we did a little study on the performance of ESG funds versus conventional funds over the COVID-19 pandemic in March 2020. And actually, we saw that ESG funds outperformed on a small margin over the first quarter last year, mainly driven by the drop in oil prices. And as you know, ESG funds have a little exposure to fossil fuels, and therefore they are were less involved in that stuff. And this is the big advantage from ESG. I mean, if you look over the big crisis we had over the couple of decades, a couple of last decades, you see that in the burst of the tech bubble, within the financial crisis, there were always companies which were not eligible for ESG investments, and they were not in those funds and had not the downturns from those companies.
Now, Detlef, those that are for ESG say, it's a no-brainer, it's good for the planet, it helps businesses manage risk. Then there are those that are against it, saying, it's very difficult at the moment and hinders the investment decisions. What are the main pitfalls and opportunities for an investor as you see it?
Well, as said before, we see obviously a limit of the investment universe as ESG investing and even harder SRI investing, so social responsible investing, excludes sectors from your investment universe. And if these are the best performing sectors, you obviously have no exposure to it and therefore an underperformance to your mainstream or conventional counterparts. On the other hand side, it's really a chance to use ESG data, because ESG data is a new level of insights you can gain into a company. And you often see that companies with a low G score or low E score are doing in long-term performance not as good as their counterparts with good scores.
Now, ESG seems to the investor that's not already exposed to this space very nebulous. So how would you advise people looking to tackle this sector?
Well, I would say people should look on the sector as they do on every other sector as well. So they need to understand the systematic of the ESG process behind the fund they are choosing, either if it is an active managed or an passive product. So you have to know what you're buying, and this should be in line with your own values and beliefs to be a successful investment.
Right, Detlef, thank you so much for your time. That was Detlef Glow, head of EMEA research at Refinitiv. Now, before I go, here are some of the top stories in the ESG space. Energy giant Royal Dutch Shell has outlined plans to curb its emissions through rapid growth of low-carbon businesses, including biofuels and hydrogen. It's also set out plans to boost the use of carbon offsets and carbon capture to soak up its emissions. The Anglo-Dutch company is in the middle of an overhaul and last year pledged to eliminate carbon emissions by 2050. The organisation representing Europe's car makers has told the EU that 1 million EV charging stations are needed in just 3 years and 3 million by 2029. The influential European Automobile Manufacturers Association told Brussels that firm targets would give consumers the confidence to switch and help car makers and power grid manufacturers plan ahead. And finally, the world's largest infrastructure investor, Macquarie, has raised just shy of $2 billion for its second global renewables fund, driven by strong demand from institutional investors in Britain and Germany. The new fund will target wind and solar projects in Europe, the United States and the Asia Pacific. And that's your roundup of the ESG sector. I'm Angeline Ong, and this is Reuters.